Moving averages. Moving averages are one of the most widely used technical indicators. Perhaps when you start doing technical analysis, it's one of the first indicators you see. And that's because it's a very simple indicator and at the same time very useful. What is a moving average? The word moving average, or the phrase, has two components. There's the moving part and there's the average part. The moving average tells us the average price of an asset over time. So the average part is looking at the average price over a particular number of days. So it may be the average price over 10 days, or the average price over 20 days or 50 days. And the moving part tells us that this average changes over time. So we calculate this average at each point in time, and this changes. And that together creates the moving average. Usually, when we calculate a moving average, we use closing prices. For example, if we were to take the moving average over the last 20 days, we would take the closing price of the asset over the last 20 days, average them, and that would be the moving average value. Why do we use moving averages, and what do they tell us? The purpose of a moving average is to create a smooth line in order to identify the underlying trend. If we have a price series, we know that price series are volatile. There will be many up and down movements over successive days. Now, whenever we take the average of a price series, this is always much more smooth than the underlying price series itself. When we plot a moving average, we'll see that the price or the line moving average is very smooth, whereas the price is very choppy. It tends to move up and down a lot. This smooth line allows us to identify whether the price is in an uptrend or a downtrend. And that's really what moving averages are all about. The purpose is to create a line to identify the trend. Now, one of the key points about moving averages is that they identify trends after they have begun. They do not predict trends in advance. Now, when we did chart patterns, we looked at patterns that were aimed at predicting a future trend. With moving averages, it's actually telling us if we are already in a trend or not. We're not really predicting them, we're saying are we in one. So moving averages are in that sense what are known as lagging indicators, meaning that they tell us something after it has occurred. Now this is good and bad for different reasons, and we'll talk about that later on. But for now, let's just keep in mind that the purpose of a moving averages is to identify a trend, and moving averages identify trends once they have already begun. Moving averages. Let's now carry on our discussion about moving averages. Let's talk about the length of a moving average. As we said, a moving average is the average price over a certain number of days. Well, how many days are we interested in? We can have a short moving average where we use a small number of days. For example, a 20-day moving average would be a short moving average in general. We can have a long moving average that uses a larger number of days. A 200-day moving average would be a long moving average. Now, what are the main differences between the two? And this is quite important. A short moving average will react much more quickly to the movements in price. Imagine we're comparing a 20-day moving average versus a 200-day moving average. Well, the 20-day moving average, because it only has 20 days of data in it, is going to move a lot more quickly, right? A new price will have a greater influence on the overall moving average. So they tend to react more quickly into the movements in price, but as a result, they are also less smooth, right? The shorter the moving average, the more closely it follows the price, and because we know the price is not smooth, the shorter moving averages are less smooth as compared with the longer moving averages. In contrast, imagine now we have a longer moving average. Imagine we had a 200-day moving average. In this case, we know it will be very smooth because the average is unlikely to change much from time to time. Because of the fact that there are 200 data points used to calculate that average, when we add a new one on a new day and drop off the oldest one, it's not going to change very much because most of the moving average components are still the same. So the longer moving averages tend to react much more slowly. And obviously there are advantages and disadvantages to both. With a shorter average, we tend to pick up trends more quickly, but we're more likely to get false signals. With a longer average, we pick up trends much later, but they're less likely to be false signals. A good way to think about them is that the shorter term moving average tells us the short term trend, whereas the longer moving average tells us the longer term trend. Now when we calculate moving averages, there are a couple of ways we can do it, which we'll talk about in the upcoming slides. So we can calculate the simple moving average, or we can calculate exponential moving average. And these are really the two main ones that people use. So we'll talk in detail about these two. There are also other forms of moving averages that can be quite complex. We're not going to spend time talking about them because they don't really get used very often. But if you want to learn more about them, you certainly can. But really the most important ones are the simple moving average and the exponential moving average. And both are used quite frequently when it comes to doing moving average trading strategies. So let's now go on to talk about them. Simple moving average. The first type of moving average we'll talk about is the simple moving average. This is probably what we're going to think of when we think of an average. So really the two different ways when we talk about simple versus exponential, they're really different ways of calculating the average price. The simple moving average essentially gives an equal weight to each data point. So if we have, let's say, 20 days, a moving average of 20 days, then each of those 20 days is given equal consideration, given equal weight in the calculation of the overall average. With the exponential average, we give more weight to more recent data. And that's really the difference. Simple moving average gives equal weight to each point, whereas the exponential moving averages give more weight to more recent points. So the more recent the data is, the more weight it gets. Now, the calculation for the simple moving average is fairly simple. If we look at the formula on the slide, it says SMA, which is simple moving average. The subscript n is the number of days, so this could be the 10-day or 20-day moving average, is equal to the sum of all the prices over n, which means that the sum of all the prices over n number of days, which could be 10 days, divided by the total number of days. So if n was 10, it would be divided by 10. So really we're just taking we're summing the price over all the days and dividing by the number of days. It's a very simple calculation of an average. It's also known as the arithmetic mean. It's probably what we're going to assume when we think of average. This is what most of us think of when we think about taking an average. And as we said, it gives an equal weight to each data point. Imagine now we have day 1 and day 20 in this 20-day moving average. Well, the importance of day 20 in terms of its weight in the calculation is the same as the importance of day 1 in the calculation of the moving average. Now this is actually one of the main criticisms of the simple moving average. The simple moving average, in it, the older prices get the same weight or the same importance as the newer prices. And the exponentially weighted moving average, or the exponential moving average, which we'll talk about a little while later, is actually addressing this criticism by giving more weight to more recent data. And it uses a slightly more complicated formula. But for now, let's just stick with the simple moving average. So we know now how to calculate it. Obviously, when you actually do it in practice, if you do it on a charting software, you won't need to calculate it yourself. If you do it in Excel, you will, and we'll go through how to do that in Excel in the coming slides. So what we're going to do now first is look at how to look at this on a charting software. So we'll look at Yahoo Finance, and then we'll turn to Excel to look at how to actually calculate it in practice. Simple moving average. Here I have a chart of the Nifty index over a 1-year period. So this is from July 2011 to July 2012. And what I'm going to do is show you how to plot a simple moving average and what it looks like. It's fairly straightforward. So in Yahoo Finance, I have to pull up the Nifty index, which you can do quite easily if you just go to finance.yahoo.com and search for Nifty index. And then you go to the chart section. And now if you can see my cursor here, I'm going to technical indicators. So if I click here, I see the simple moving average over here, SMA. So I can click on that. And then it allows me to draw, in this case, up to 3 lines of moving average. So what I'm going to do is draw for us the 10-day moving average and I'm going to draw the 50-day moving average. And I click draw. And then you can see this is what it looks like. So in this case, the red line is the 10-day moving average. You can see it up here. And the green line is the 50-day moving average. And these are simple moving averages. And we can see quite clearly here that the red line, the shorter moving averages, tends to follow the price a lot more closely. It's still smoother than the underlying price, but it moves a lot more when the price moves. However, with the green line, the 50-day moving average, this is a longer moving average, and we can see that this is a lot smoother than the red line. It moves a lot more slowly, it reacts more slowly, because it is a longer moving average. So hopefully now we can see what the moving average looks like, and we can really plot any number of days. So I chose 10 and 50, but you could choose 20 and 100, you could choose even weird numbers like 7 and 32. You can really plot any moving average you want, and then you'll see how it moves in relation to how the price moves. And now what we'll do is take a look at it in Excel and see how to calculate it. Simple moving average. Now here we are in Excel, and I have a spreadsheet here. This spreadsheet contains the prices of the Nifty index from the end of 2011, so that's the last price, and the earliest price, if I go all the way down, is the beginning of 2005. So this is quite a long series of data. And if you remember earlier on in the course, we actually went through a moving average example. This was back in lecture 4. So this is actually the same data that we're going to use. And we'll keep it consistent just so that when we go through it, it makes sense of how to use it. And what I'm going to do now is show you how to calculate a simple moving average in Excel so that whenever we want to implement trading strategies, we can do so. So let me go to this SMA tab, which is the simple moving average. Now, here I am, and you can see it's actually exactly the same as the previous one. So what I'm going to do is do the same thing that we did before. So we had the 10-day moving average and the 50-day moving average. So I will calculate them and show you exactly how to do so. So what we will do is we'll draw SMA 10, which is simple moving average 10, and we'll do SMA 50, which is simple moving average 50. Okay? The 10-day moving average is very simple. It will be equal to the average, which is just average of the last 10 days, which will be from B2, that is this number here, and 10 days will take us all the way until B11, right? So that will be up to B11. And that then is the 10-day moving average. Now I can do that to make the data go all the way to the end. And I just want to be clear that at this point, so these first 10 obviously will not contain 10-day moving averages because we don't have values before that. So what I will just do is delete the ones that don't have any value. So this is the last 10-day moving average that we have. So let me I won't delete those, but I'll just color them yellow so that we know that they're not really a 10-day moving average. But all the rest of them are. And likewise, with the 50-day moving average, we can calculate it in the same way. So just like we did here, we'll take the average of B2 and before we did it until B11, which was a 10-day moving average, this time we'll do it until B51, which will be 50 days. Alright, and that's the 50-day moving average. And again, I can just copy this down all the way, and I probably want to yellow out the portions that are not part of the moving average calculation. So I believe it will be everything from this line down, and that's fine. Okay, so that's how we calculate the simple moving average. I've done it for the 10-day and I've done it for the 50-day. So you can see it's fairly straightforward to do. We can kind of do it for any day length that we like. And it's a really simple calculation. We're just taking the average of the previous 10 days or the previous 50 days, and that becomes our simple moving average. So this is the same as what we did in the chart, except now we have it in number form instead of visually. Exponential moving average. As we said earlier, the simple moving average suffers from one fairly important shortcoming. The shortcoming is that the simple moving average gives equal weight to old data as well as new data. And a lot of analysts and technicians believe that we should be giving more weight to more recent data. That is, the new data is more important than the previous data because the new data tells us more about what's going to happen in the future. The exponential moving average is a solution to this problem. The way we do this is that we actually take into account all the data in the price series, and we put the greatest weight on the most recent data. So we'll take data from, let's say the previous day's price all the way going down, and the more recent the data is, the greater the weight it gets. So let's take a look quickly at the formula for the exponential moving average. This is a slightly complicated formula, and I'm not expecting you to understand, be able to prove why it works, but we will use it when we actually do the calculation in Excel. So we do need to be aware of it. The exponentially weighted moving average, or the exponential moving average for n number of days, so it could be 20 day, 50 day, etc., is equal to the price, the current price, minus the exponential moving average of the previous day, times 2 divided by n, which is again the number of days of moving average, plus 1. All of that plus the exponential moving average of the previous day. Again, why this formula is the way it is, it's not really very important. If you're interested in understanding how it's derived, you can look it up in the Murphy book or online. But really, it's actually a simple calculation, and we'll do it in Excel. And what this does is that it just gives a more recent data greater weights. Now, if we were to compare it with a simple moving average, what we would see is that it reacts much more quickly. This is because of the fact that it gives more recent weight, gives more weight to more recent data, and as a result, it reacts more quickly to new prices. So this is the shortcoming of the simple moving average that gets addressed. Now there are other weighted moving averages. So for example, there is the linearly weighted moving average. We're not really going to talk about the other ones because they're not used that much in practice. The exponential moving average is used a lot, so this one we definitely need to know. The exponential are the simple of the two main ones, but really there are multiple ways we can weight moving averages. We can have any kind of weighting scheme we want, but for now let's stick with the exponential. So let's go back and now we'll look at Yahoo Finance to see what it looks like on a chart, and then we'll also calculate it in Excel. Exponential moving average. Here we are back in Yahoo Finance with the same chart that we had before. What I'm going to do is I'm going to go into here and remove the simple moving averages. Okay, so we're back to a clean chart, and this time we'll plot the exponential moving average, which is also in here. So this is the EMA, and again I can do the same ones. I can do the 10-day exponential moving average and the 50-day exponential moving average. I click draw, and then you can see it gives us the exponential moving average for 10 days versus 50 days. And you can see doesn't look too different to the simple moving average. But you can see again the 10-day moving average tends to follow the price more closely, whereas the 50-day moving average reacts more slowly because it's a longer dated moving average. So again, that's straightforward. One thing that will be interesting to see is we can compare the simple and the exponential to see how they look different. So what I'll do is I'll remove first what I've drawn so far, and then let me plot a simple moving average of 10 days, and then I will also plot a exponential moving average of 10 days, and this way you can compare what they look like and how they're different. Now, as you can see, they look very, very similar, right? They're almost along the same lines, but you can just about see that the brown line, which is the exponential moving average, tends to move just a little bit before the red one. So here, for example, where my cursor is, you can see the price starts going up here, and the exponential average goes up before the simple average. Right, and this is because it gives more weight to more recent data. And all along, you'll see that the exponential moving average moves just a little bit earlier than the simple moving average. So in that sense, it's slightly more advantageous because it gives us that head start. But you can also see that there's actually not a huge difference. In practice, it may not matter much which one you use. Even throughout most of this, they're actually very, very close together. So we can see the exponential moving average does react quickly, but it's also very, very similar to the simple moving average anyway. Exponential moving average. Here we are back in Excel to the same place where we left off. So we left off calculating the simple moving average of 10 days and 50 days. Now what we're going to do is calculate the exponential moving average. Okay, so I'm going to go to this EMA tab here. And again, it's the same before, just the date and the value of the index. And we'll calculate the exponential moving average, again, for 10 days. And we'll do the exponential moving average for 50 days. So what we need to do is that the exponential moving average takes the previous day's exponential moving average as its base value. So in the very last column, we need to copy across the price, okay? And we just have to keep in mind that these two prices are not to be used in the calculation. Are to be used in the calculation, but they don't actually represent the actual moving average. Just like in the previous, when we previously looked at the simple moving average, we had to discount the last 10 days or the last 50 days. So in this case, we want to do the same thing. We want to discount sort of the last 10 to 50 days, but we can apply the formula kind of across. So you actually need to start by applying the formula at the bottom. So the way the formula works is that the exponential moving average for that day is equal to the current price minus the exponential moving average of the previous day. In this case, we'll do that. So like I said, for this case, as we go up the chart, then this will correct itself. It's just because it's a 10-day average, so we need to have about 10 days for it to be correct. We do this. We then multiply it by 2 divided by n plus 1. So in this case, it'll be 10 plus 1. Okay? And then we add the previous day's moving average. So that's what it will be. And then we can take this formula and copy it all the way up. And this gives us the 10-day exponential moving average. Alright, again, the formula may be slightly more complicated, but actually it's once you know how to implement it, it's fairly simple. So in this case, we're going to implement the same formula, except it'll be a 50-day instead of a 10-day. So I'm going to copy this formula across here, and the only thing I'm going to change, one is that we have to use the actual price, which is B, not C, and we're going to change 10 to 50 because it's a 50-day exponential average. Then I can take this, copy this all the way up, and I now have my 50-day exponential moving average. So this is how it's calculated. Again, try not to be confused by the fact that for the very first day in the series, we had to use the actual value of the price. This is because there's no day before it, and that's okay. So but this is how we calculate the exponential moving average. Alright, let's now go back, and in the next part, we'll now talk about some moving average trading strategies. Now that we know how to calculate both the simple and exponential moving average, we've seen it on a chart and we've also seen it in Excel. We can now go back and try and come up with some trading strategies using these calculations we have done. And just like with the simple average, we can do the exponential average for any number of days we want, right? It doesn't really matter. Okay? Moving average crossover. Now what we are going to do is talk about a trading strategy with moving averages. And this is a very common trading strategy. We did talk about it in the early part of the lecture, but we're going to go through it again and in a bit more detail this time. With a moving average crossover strategy, we use two moving averages, one short and one long. And here's how it works. When the shorter moving average crosses above the longer moving average, this generates a buy signal. When the shorter average crosses below the longer average, this generates a sell signal. What does this mean? Well, essentially, whenever the shorter moving average, so let's say we were using a 10-day and a 50-day moving average, whenever the 10-day moving average was above the 50-day moving average, or whenever it crosses it from below and ends up above, that means we should buy. That's a buy signal. Whenever that 10-day moving average falls below that 50-day moving average, that would be a sell signal. So you can see it's a fairly simple strategy. And what its intuition tells us is that the crossing of the shorter and the longer moving average are used to signal a definite change in the trend. And this is quite important because rather than just using one moving average to tell us about the trend, right? Because we have this problem, right? We have long moving averages and short ones. And if we use a short one, then it may change too frequently because it follows the price too closely. If we use a long one, we may not pick up changes in the trend very quickly. So this is a way to solve this problem. We're going to use a short and a long one. And only when the short one is rising and does it rise above the long one do we want to initiate a long position. Or only when the short one is falling and goes below the long one do we want to initiate a short position. And the result of this is that we end up with fewer false signals or whipsaws. Right? Whipsaw, which we'll talk about a little later, essentially occurs when moving averages are very close to the price and they cross each other lots and lots of times. And in this case, you're getting a lot of false signals, right? In this case, the markets are not really trending in either direction and you're just ending up with a bunch of false signals and that's leading to losses. And when we talk about the weaknesses of moving averages, we'll talk about the fact that they don't tend to work when markets are not trending. So as a result, we may end up with whipsaws. So this moving average crossover is a way to try and eliminate the whipsaw problem so that we end up with fewer false signals. And it does come at a cost. It means that we do have a bit of a lag. Again, as compared with, say, if we just use a short moving average, we would find trends more quickly, but we would also get more whipsaws. So again, it's all a balancing act, right? Using a long versus a short. In this case, we're going to use them together. So what we'll do is we'll look at this visually on a graph. And then we'll actually do it in Excel. We'll do a more detailed calculation in Excel. Moving average crossover. Here we are back in Yahoo Finance. And what we're going to do now is just clean this chart up. So we'll take out the moving averages that we have drawn. And then what we're going to do is plot a moving averages, two different moving averages, one short and one long. And actually look at a moving average crossover strategy from a visual perspective, seeing how and when we would implement it. So let's go with a simple moving average. Again, we can use simple or exponential. It doesn't, either one is fine. We'll just do simple for now. Again, when we actually go through trading systems, we'll have an optimization method that tells us which one is the best to use. But for now, let's just use a simple moving average. And I'm going to use a 10-day and a 50-day moving average like we drew before. So I draw this, and now I'm going to try and explain to you when exactly are we going to have a long position and a short position. So the first place we would initiate a position is here. Right here, the 10-day average is crossing below the 50-day average. That would mean a short position. So throughout this position, we would be short. And as long as the red line is below the green line, we want to be short. Then here, when the red line crosses the green line and ends up above, then we want to take a long position. So we would be long over here. And then again here at this point, when the red line crosses the green line and goes below, we take a short position. We stay short throughout this. At this point here, again, we would take a long position. And you can see at this point here, this long position would do very well because there was a huge up movement. In a lot of these cases, we may have just about broken even. I think there were some gains, some losses. Here we would have made a good amount of money. And then we would hold this long position all the way up to here, where we would again want to take a short position. And we would hold this until the next cross, which was here. So again, we'd make a little bit of money doing that, and then take a long position from there. So you can see it's fairly intuitive as to how this works. All we need to do is ensure that whenever the shorter moving average is above this longer moving average, we have a long position. And whenever the shorter moving average is below the long moving average, then we have a short position. And that's all we really need in order to implement this strategy. So it's actually a fairly simple strategy. And now that you've seen it visually, what we're going to do now is actually calculate it in Excel. So we'll do the strategy in Excel. And what we'll do is we'll do it much more mechanically. We'll actually see how much money exactly would we make or lose by implementing this particular strategy, and we'll go with the same parameters that we have here. Moving average crossover. Here we are back in Excel, and what we are going to do now is actually implement this moving average crossover strategy and see how it would perform on historical data. Right? So we'll use this Nifty index. We'll look at exactly how would the strategy perform had we implemented it in the past. So I'm going to take the simple moving averages, the 10-day and the 50-day. So I'm just going to copy all of this. Alright, and in this MAC, which is moving average crossover tab, then I will paste special values, okay? Which means I don't copy the formulas across, I just copy the values. Alright, and let me just clean this up a little bit. This will be like that, okay? And then, as we said, in 2005 we have data that some of it was not necessarily correct because we don't use all the days of the moving average. So what we'll just do is we'll just be really simple and just cut off all of that, all of 2005. So we're really just implementing the strategy from 2006 onwards. Alright, so let's follow some simple rules here. So what we're going to do is we're going to have a return here. This is the return on the Nifty index. So this is how much would we make by holding that index. And let's just assume that whenever we trade this, we're looking at the absolute return. So for example, if I was holding, let's say, one futures contract in the Nifty index, I would just earn, say, the difference between the two. Okay, now you can do this as a percentage as well. So if we wanted to do a percentage return, we would have this and then divided by that. So one way to do it is like that, but we'll just do it looking at the absolute return. So we're not going to worry too much about the percentage return. We just assume we're going to hold it either long or short one contract, and there's a multiplier effect, so we don't really need to worry about the percentage return. So I'll copy this all the way down, and this tells us how much the Nifty index returned. Again, this value, bottom one, we can ignore. So let me just cancel that. Now what we can see here is that this is just the difference between the two, right? So when the market's going down, the return is negative, and when the market's going up, the return is positive. And then I'm going to have the position here. Alright, this is whether I'm going to have a long position or a short position. Alright, so let's say we want 1 to equal a long position and -1 to equal a short position. And then finally here I'm going to have the moving average crossover return. That is, how much do I get from my own strategy. Right, so this return is the return on the index itself. Right, this is the buy and hold return. Right, if we were to just hold the index on its own, how much would we make? Whereas this one will be the position that I take, so either long or short, and this one will be the return from that long position or that short position. Alright, so let's remember our criteria for this moving average crossover strategy. So whenever the simple moving average, that is SMA 10, is greater than the longer dated moving average, that is SMA 50, then I want to have a long position, and whenever it's lower, I want to have a short position. Now let's remember that in each of these cases, so for example, if I'm looking at the position on this day, I need to use the moving averages from the previous days, right? Because I don't actually know this until the end of the day, these two moving averages, but I know the previous day's moving averages. So whenever I calculate in my position, will be based on the previous 2 days, the previous day's moving averages, right? That is the close of business previous day. And then I initiate my position at the close, all right? And I hold it for the day, and then I earn the return, which is here on that day. Okay? So my position vector will look something like this. We'll be using the if function. So it will say if the simple moving average, all right, is greater than the longer moving average, SMA 10 is greater than SMA 50, then I have a long position, which is a 1. And if not, then I'm going to have a short position, which is -1. Okay? Now, if you didn't understand how we did this if formula, again, we just have the condition here, one greater than the other. Then this is what happens if that condition holds. So if C3 is greater than D3, then give me a 1. If it's not greater, then give me a -1. So that's how this works. You can go back to the Excel tutorial earlier lectures if you're struggling with this, but this if function is quite important. So this will give me a 1 or a -1. All right, in this case it's -1. So we can see here that in this case the 50 day was greater than the 10 day, so I want to be short. All right, and then I need to just bring this down all the way. Okay, and again, let's ignore the last one because we don't initiate a position on the very first day. And you can see this consists of 1s, and then -1s, and then -1s, etc. All right. Now my return will be equal. So now this, I'm going to be looking at the return from my particular strategy, from the moving average crossover strategy. So my return will be equal to the position that I've taken multiplied by the actual return on the index. In this case, here it'll just be equal to the return times the position. So that's how much I make from this position, right? So in this case, I had a short position. The market fell by 21.95, so I make 21.95. Makes sense, right? If I was short, I made money. If I was long, then this would be 1, then I would lose money. So this then is the moving average crossover return on that particular day. So let me just take this all the way down, and you can see whenever we have brackets, by the way, that's negative. You can see some days we have positive returns and some days we have negative returns. And now here we have it. This is how much we would earn by implementing the moving average crossover strategy. So like we looked at on the chart, right? On the chart we looked at, well, we take a long position here, would we make or lose money, etc. And on the chart, unfortunately, it's only very intuitive. We can't actually look at the actual numbers. In this case, we can look at the actual numbers. So, for example, one thing that would be quite interesting for us to know is that, well, how much would we earn in total over the course of all these years from 2006 to 2011 using the moving average crossover strategy. So I can just do the sum of column G, all right, and it's -10, okay, which tells us that actually this strategy would lose us money over this long period. And that's quite interesting because it means that this was obviously not a good strategy for this particular index. Now this can happen for a variety of reasons. We can look here, we see that there were many large losses during this time, and here there were many losses as well. So again, over this time period, the moving average crossover strategy was not necessarily profitable. But again, this is how we tested and implemented. So we know, for example, that using this simple moving average of 10 and simple moving average of 50 actually did not produce us with something profitable. Alright? But, you can try different parameters. You can try 20 and 100 and see if that would produce you something profitable. So let's say, for example, I want to try 20, 100. All I would need to do is change this to calculate the 20 day and the 100 day and follow the same return. And you can see the return on different days. So even though over the whole period it wasn't profitable, you might find that, for example, let's say December 2011, sum is 207, it was profitable. Right? As we said, the moving average crossover strategy, there are periods when it works and there are periods when it doesn't work. So you have to really, when we'll talk about when we do trading systems, how to find out when things work and when things don't. But now we get an idea of how to implement it. And clearly there are many instances where it does work quite well. So that's how we implement this, okay? And we'll now go back to our PowerPoint presentation where we'll talk about the triple crossover strategy. But by now we should all be clear on how the moving average crossover strategy works. Triple crossover. So now in the last Excel exercise, we looked at the moving average crossover strategy. And we found that it actually was not profitable with those parameters. So the 10-day, 50-day simple moving average turned out not to be a good strategy. And that's okay. The fact is that there are many strategies that would otherwise work too. So we could try different parameters. We could try, say, 20 and 100. We could try, say, 5 and 20. We could also try using the exponential average instead. So don't be discouraged by the fact that that did not produce something profitable. It was just an exercise. It was really just to show you how the moving average technical indicator works. So now let's talk about the triple crossover, which is a variation on this strategy. And this time, instead of 2 moving averages, we have 3. So we have a short moving average, a medium moving average, and a long moving average. Now this is slightly more complicated how it works, so try and follow along here. When the short moving averages crosses above both the medium and longer average, this is a buy alert. Not a buy signal, a buy alert, which means that we should be preparing to buy. When the medium average then crosses above the long average, then this is a buy signal. Okay, so we need it to be the case that the short average crosses both the medium and the long average. And we also need that the medium average is also crossing the long average. That's a buy signal. Okay? Now, when the short moving average crosses below both the medium and longer average, then we have a sell alert. Again, not a sell signal. And when the medium average then crosses below the long average, then we have a sell signal. So in practice, let's think about what this would look like. What it would mean is that we would need the short to be above the medium to be above the long average for a buy signal. For a sell signal, we would be the short to be below the medium, which we should be below the long for a sell signal. That's the buy and the sell signal. Now, intermediate periods require no position. So if there are periods where that order is not there in either way, then we don't have to have any position. However, as we said, we can have buy alerts before buy signals. Sometimes buy alerts can be used to close an existing short. So not necessarily to take a new short position, but to close an existing one. And we can use sell alerts to close an existing long position. So a sell alert can be used to close an existing long position, but not necessarily initiate a new short position. So this strategy, again, is slightly more complicated than the moving average crossover strategy when we just had 2, but it relies on more or less the same principles. Again, we're using them to identify changes in the trend. And really what we're doing here is that we're saying that we need both 2 different conditions to occur for a signal to take place, right? We need the short to be above the medium and the medium to be above the long. So it's more stricter than just the moving average crossover. And we hope that this produces a better outcome. And when we go into Excel, we'll see whether it does or not. Let's now first look at the Yahoo Finance chart and see what this looks like visually. Triple crossover. Now here we are back in Yahoo Finance. So I'm going to just change the technical indicator. I'm going to just remove these. So we start with the clean chart. Now what we're going to do is see exactly what the triple crossover looks like intuitively. So let's select 3 different simple moving averages. Let's say, for example, we take a 5-day, we take a 20-day, and we take a 100-day moving average. Okay? Alright, so now we have a few different lines. We have a red line, we have a green line, and we have a blue line. The red is the 5-day, this is the 20-day, the green one, and the blue one is the 100-day. So what we have is a situation whereby now we need the red for a short position, we need the red to be below the green to be below the blue. That's a short position. And we need the red to be above the green to be above the blue for a long position. So let's see if we have any positions here that we can actually take. Well, right off the bat here, you can see that right around here, the red line is below the green line, which is below the blue line. So this would be a signal for a short position. Alright, and this would do well because the price would go down afterwards. And then this here would be a buy alert, which would make us close the position. Alright, and if we go over here, again, we'll have a situation where we have another short over here, right? Because here the red line is below the green line and the blue line, so that would be another short position. And this would be closed out around here, which would give us some profit as well. And then if we go down here, we finally have a case for a long position. Here we have the red line. At this point here, the red line is above the green line, which is above the blue line. Now, if you remember in the earlier chart, the long position was given to us earlier than here, right? Here we have more stricter conditions, so it takes a little longer for the trend to be in place. And again, we go up and this would be our signal to close it out, right? So whenever there's not in that particular order, then we would just have no position. And then again here, finally, we would have another short position. This would actually end up losing us money because the price would sort of end up going up afterwards, or we'd be roughly even, and then so on. So now you get a basic idea of what this looks like intuitively, right? What does it look like when we have three different moving averages and have all next to each other? And we can see the 5-day sort of hugs the price very, very closely. So it's almost almost like using the price itself, but not quite. So what we'll do now is that we'll go back into Excel, just like we did previously, and we'll implement this strategy and see exactly how to implement it and see how it would turn out, if it would turn out well or not. Triple crossover. Here we are back in Excel, and what we are going to do now is implement the triple crossover strategy, just like we did with the moving average crossover. We'll use the same parameters that we did before. We'll use that we did in the chart. We'll use 5, 20, and 100 day simple moving averages. So let's go into TC, which is triple crossover. And again, we're just going to start with the nifty prices. The moving averages we'll be calculating are 5, 20, and 100. Okay, so first let's calculate those. So this will be the average of B2 to B6. This one will be the average of B2 to B21. And this one will be the average of B2 to B101. Okay, so let me just copy these all the way down. And this is our moving averages for 5, 20, and 100 days. I'm just going to turn these formulas into values, so we don't really need to worry about anything happening to them. And as we did before, I'm going to knock off all of the data up to in 2005. So we'll just be considering 2006 data because we really just want the 2005 for the calculations of the averages. Okay, so all of that gets chopped off. And now we're back to what we had before. So what we're going to do now is calculate the position, right? That is, what is our position, right? Long, short, or no position. Before we do that, we'll just quickly do the return. So this is just like we did before. This is the return on the Nifty index. This goes all the way down, and again, the first value will disappear. So now let's think about the position. Right now, it's slightly more complicated than before because what we have is that we now have buy signals and sell signals, but we also have times where we'll have no position. So we really need two different conditions to be satisfied for us to take a position. So let me just do alert 1, okay, and alert 2, and using those two together, we'll know whether we need a position or not. So the first thing we want to look at is the 5-day greater or less than the 20-day moving average? So I'm going to say if the 5-day is greater than the 20-day, then give me a long position 1. Otherwise, give me -1. Okay, then it's a sell alert. So this is just like we did before, right? 1s and -1s. And now I'm going to do the same thing with this alert 2, except I'll do it with the 20 and the 100 day. So if the 20 day is greater than the 100 day, then give me a 1. Otherwise, give me a -1. Okay? So if you can see, only instances where these two are the same should we actually have a position, right? Because in this case, we have the 5 is less than the 20. And in this case, we also have the 20 is less than 100. So that should be a short position, right? Both are -1. They should be a short. If both are 1, then we should have a long, right? Because then 5 is greater than the 20, and also the 20 days greater than 100. However, if they are different, if one is -1 and the other is 1, then we have no position. So now, we're going to use a little trick to create this. We know that if we multiply these two together, if we multiply -1 and -1, we get 1. If we multiply 1 and 1, we also get 1. However, if they're different numbers and we multiply them, we'll get -1. So what we can say is that if this times this is equal to 1, that means we have to take a position, right? Because if they're the same sign, they'll equal 1, the multiplication. Then we want to take a position equal to whatever the alert was, right? So if it's a short position, it should be -1. Otherwise, give me 0. Okay, so in this case, you can see, because this times this is equal to 1, right, then it gives us this, a short position. Now, I'll take this all the way down, and you can see there are some instances where we have no position, right, where these two are different, right? In that case, we have no position. I actually just want to correct one mistake that we made. We should not be using 2, we should be using 3, right, because we need to be using it on the previous day, so apologies for that. And with that as well. So if I just redo that and redo that, now it's fine. Sorry about that. So here we have, going back to where we were, we have, in these cases, they're the same sign, right? And then it gives me a -1 as the position I need to take. In these cases, they're different signs. This one is 1, that's -1, so I end up with no position. Okay? I can go down, and there will be times when I have to have a long position as well. Alright, so for example, over here, these are both 1. In that case, I have a long position. Okay, so you can see we've done this little trick to kind of tell us what position to take. And then finally, we need to calculate the return. So I do TC return, and this is just equal to the position I take times the return, just like before. Okay, and I go all the way to the bottom, and I'm going to get rid of this, this last one here is nothing there. That's fine. Let's get rid of these as well. And now we can see the returns that I made from this strategy. So let's take a look at the sum of the returns. Let's say if we actually make a profit doing this one. So if I sum column J, well, look, I get a profit of 3,044. So what you can see is that in this case, this strategy works much, much better. Right? This strategy actually gives me a nice profit, whereas the other strategy didn't give me any profit at all, right? And in this case, it's actually the case that you may even get more than the buy and hold return. So if I were to sum, let's say, column F, which is the buy and hold return, okay, I get less, right? I get 1,788 from doing a buy and hold, but I get 3,044 from doing this triple crossover strategy. So in this case, you can see the triple crossover very clearly dominates the buy and hold. It also definitely dominates the moving average crossover strategy we saw before. Again, it'll vary depending on your parameters, and there are lots of things we can do to improve the strategy. One thing to caution is that we haven't taken transaction costs into account, so the costs of executing each trade, and that will actually reduce the return somewhat. But when we go into technical trading systems, we'll actually talk about how to do this so we get more realistic returns. But you can see in principle how the strategy works. It actually works really well. It gives us a really good profit, and you can see how we came up with it. There are times when we don't have any positions, and that's fine. And overall, we tend to make a very strong return following this strategy. Alright, so that concludes this part of the lecture now. So we'll go back to the PowerPoint slides, and we'll conclude the lecture by talking about some of the weaknesses of the moving averages, and then we'll conclude the lecture. Weaknesses. So as we said, now we'll go on to talk about some of the weaknesses of moving averages and moving average strategies in particular. Now that we've had a chance to see exactly how to implement both the moving average crossover strategy as well as the triple crossover strategy. Now the main weakness of moving averages, as we know, moving averages are used to identify trends. And they do a really good job whenever there are trends in place. However, they tend to not work when markets are not trending. If we have a situation whereby the market is not trending, alright, then moving average strategies will generally not work. So during a non-trending period, moving averages tend to produce numerous whipsaws or false signals. So whipsaws, as we said, exist when there is a lot of crossing of the moving averages, so that we keep lamenting positions and they keep turning around and going the wrong way. And that can happen when the moving averages are very close together. So one way around this is to use what's called a band. Now if you remember again in the fourth lecture, we briefly talked about a band, whereby rather than have the crossing of the moving averages, we want a crossing and we want it to exceed by a certain percent. Let's say we need the short moving average to exceed the long one by 1%, or 0.5%, or 2%. So basically make the criteria more strict so that we avoid these whipsaws. So that's one way we can avoid whipsaws and avoid some of the false signals. Another way is this triple crossover. So triple crossover is a more strict strategy. That is, it requires more conditions in place before we execute a position. And this also, as we saw in our Excel examples, this also ended up producing a more profitable strategy overall. So there are ways to get around the weaknesses, but what we should know is that if the markets are not trending, then we generally will not make money using a moving average strategy. And these variations are designed to tell us when the market is not trending, that is, when to stay out of the market. The other weakness about moving averages is that we don't necessarily know what length of moving average to use. Should we use 5 days? Should we use 10 days? So we saw when we did the moving average crossover that when we used 10 and 50, it produced a fairly poor result. Well, maybe if we had used 20 and 100, it would have produced a better result. Well, we don't know, right? And this is another one of the weaknesses of using moving averages, is that we do not necessarily know which ones to use. There are again ways around this, so we can do some optimization, and what that means is that we try out different ones to find the best. And this is actually a good thing to do. Again, when we talk about technical trading systems, we'll look at how to do this. But there are ways around this. So the main weaknesses that we really need to be concerned about is that we do not want to use moving averages when the markets are not trending. If we know that, if there's something that tells us the markets are not trending, then we should stay away from moving averages and use a different indicator.